All right, Anton Stentner podcast number 40.
4D.
We're here, and today we're talking about what we've talked about so much, but for 2024, which is where are interest rates going next year?
Yeah.
Where do you want to start? Because I have so many questions myself.
It's crazy when I go through and do the research on this and I get excited like reading more about the topic. So I think with this one initially what I want to do is I want to set the stage for what I think is going to happen in 2024. So one, we expect mortgage rates are going to fall slightly. And that's kind of the general consensus. We expect home rates are going to go up slightly, modestly. I'm sorry, Crash Bros. We don't see the crash. 3, we kind of expect rates, prices, and household incomes, that to be working together to make housing about 5% more affordable by the end of 2024. So if rates get a little better and prices are calm and people's income goes up slightly like it does every year, housing should be more affordable towards the latter part of 2024. Also, we got to full disclosure, forecasting is fake. So everyone that makes a forecast, we're all making a guess. I'm making guesses. These economists are making guesses. These major financial institutions are making guesses. So for those of you that are listening, hey, comment your guess. Are we going to be in the 8s? We're going to be in the 10s? We're going to be in the 7s, the 6s, the 5s? Where are interest rates going? Because right now, no one knows. And as we go through this, you're going to see that a lot of these major financial institutions, they're just all over the board. We got to bring back in the lock-in effect. So according to Freddie Mac, 2/3 of all homeowners in the United States have a rate below 4% right now. That's going to keep supply really, really tight. If rates drop a bunch, okay, that'll maybe unlock some of that supply, but that doesn't look like it's going to happen. Also, 92% of all mortgages are under 6%, so below where we're at today. Lastly, we have to talk about what the Fed is actually concerned about. So the Fed is concerned about what is known as real interest rates. Real interest rates is where we take the nominal interest rate minus the rate of inflation. That is how the Federal Reserve will shrink or grow our economy. So the Fed funds rate today is about 5.5%. And the Fed's favorite metric, PCE, is 3.5%. So you take 5.5% minus 3.5%, you have these real interest rates of about 2%, which the Fed has called sufficiently restrictive. So that 2% is restrictive. So naturally, the thing to be thinking about is we know inflation is trending what? Up or down now?
It's going down, supposedly.
It's going down. Yeah, we're not feeling it in our pocketbooks, but inflation is definitely trending down. So if inflation continues to trend down, that means next year we could foresee a time where we would be at, let's say, 2.5 for the rate of inflation versus the 3.5 today. So if you take the Fed's fund rate of 5.5 minus that 2.5%, that gives us a real rate of 3%, which would be more restrictive. So if the economy is already contracting and we know inflation's going down, it makes logical sense that the Fed is therefore going to reduce the Fed's fund rate while still being restrictive, while still being higher for longer, and causing the economy to continue to slow down even while rates are decreasing. If you are getting value out of this, please hit that subscribe button and connect with us. As you can see, with that, the market is projecting in right now up to 100 basis points cut because of that reason. If inflation goes from 3.5 to 2.5, the Fed could naturally cut 1% next year in order to get lower interest rates. What are your thoughts?
Well, it's interesting what you said, and we should get back to this unless you want to talk about it right now, about how forecasts are shit, basically. It's just unpredictable because wars, geopolitics, got elections, just natural disasters, so many variables. But then my question was, how far into the future can you predict more accurately? Right? And what are the things that you look at? Because one thing I really respect about you, I guess this kind of answer the question, is you look at the data.
Yep.
So short term, you have a pretty good feel. But I had the most random thought. I was like, forecasts are unpredictable. Nobody can truly predict it. Why does the Fed even make announcements about what they may or may not do or what they're doing, their explanations? Why don't they just put out a number and say, this is the number this month?
Because one of their major tools that they use to control us is their mouth, is their language, is the messaging they're conveying. That's why they hold so many press conferences. They kick the number out there, and then they can go and say, that number's horrible, or that number's the best number ever. And that influences the stock market to actually do something afterwards. It influences the whole economy and influences other countries. So the Fed's going to always use their mouthpiece as a major tool for good and for bad to influence what's happening. You asked the question, where or how far can we predict? With rates, we can't predict where they're going even on a daily basis because they're so volatile. They move up and down all the time. We just saw that rates were just over 8%, and then boom, all of a sudden we're back to like 7.2. That happened because of what the Fed said. That happened because of devaluing of the dollar, and that happened because the market was feeling like the Fed was done raising. So that caused that natural collapse in about 1% to happen, and that happened in less than 30 days. What we use data for is we use data for stuff that are controllable variables, looking at long-term things like the number of building permits being built, the number of development applications going in, population trends, jobs, things like that. We're looking at housing supply, number of new listings, prices. So we can get a really tight feel for the local market. That's good for 30 days to sometimes as long as 6 months. But, the national economy or major geopolitical events and interest rates are like off the table because we don't have any control over them, and they're going to move much faster. So we're looking at slower moving data, which we can see kind of moving like an iceberg, iceberg dead ahead, and it's just click, 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 versus interest rates, they dropped 1% in a month.
So let's get right into the predictions, I guess, for the next year. So in the next 3 to 12 months, what are the predictions for where interest rates will be in 2024?
Yeah, so the 30-year fixed mortgage forecast, and this is Fannie Mae, Mortgage Bankers Association, and Wells Fargo. What's interesting is the MBA, which is the Mortgage Bankers Association, is definitely the most optimistic out of them. So let's go with that. The Mortgage Bankers Association was predicting by the end of 2024, we end the year at 6.1%, and by 2025, we're back in the mid-fives at 5.5%. Now I want to go over kind of each one of these individually, and we're going to start with the bear. So Fannie Mae was the biggest bear here. They believe for 2024 that interest rates will be 7.3%. Goldman Sachs talked about ending the year at 7.1. We talked about the bull, Mortgage Bankers Association, 6.1. The National Association of Home Builders, just a little over 7.04. NAR, National Association of Realtors, 6.3. Realtor.com, 6.8. Wells Fargo, another bull. Okay, so they thought we would be at 6.59 mid-year, and they said we were going to finish 2024 at 6%. So you've got Wells Fargo and the Mortgage Bankers Association definitely being the absolute bulls there at the low sixes. Now, there are other people too. Hey, it's going to go up to 8. So these predictions all over the board. I tried to get kind of the median, the middle of the pack that was the most representative of the data. And there's something to remember here. At the start of 2023, economists predicted that mortgage rates would gradually decline throughout the year. And that forecast didn't come true at all. So for this year, they predicted they were going to go down. And what did it do? It went down for a little bit, and then we went up to 8. And almost no one was predicting that. And then, of course, they've come back down since the peak.
Why did it go up?
It went up to 8 because the Federal Reserve went on a speaking rampage right before, and they said, this is the problem, this is the problem, this is the problem. You had the major conflict with Israel and Hamas. You had a flight then to the dollar, strengthening the dollar. So yields on treasuries went up. And as yields on treasuries go up, interest rates go up.
Awesome. Yeah, and I'm just curious because that goes back to your original point that we can't predict and forecasts really aren't accurate because everyone was saying it would go down, which I remember last year. It was already kind of starting to go up and, things were getting tight in. Everyone kind of thought, yeah, it could potentially go down. No one would have thought it would go up, and then 8%. But you know what? We're going to have to look back at that content because I believe last December I was saying we are going to go up.
Well, good thing we didn't bet on it. I think Jerome Powell said it best at the last news conference in September. He said, forecasts are highly uncertain and forecasting is very difficult. Forecasters are a humble lot with much to be humble about. And so we always have to be careful as we are forecasting. And so in summary, going into 2024, most economists believe that rates should decline somewhat throughout the year, but they can't agree on how much rates will fall or the rate at which rates will fall. And they predict relief happening second quarter towards the latter part of the year, most of that relief coming later. And if you think about it logically, this is such a safe forecast to make, it's not even funny. Let's go back to what we just talked about with the Federal Reserve. As inflation comes down, that real interest rate goes up so the Fed can lower. As uncertainty leaves the market, yields and bonds go down. As yields and bond goes down, 30-year debt goes down. I mean, these just run hand in hand. If you like this, hit that subscribe button, please. So now I want to dig into kind of what each one said a little bit more. So Fannie Mae said rates are going to stay above 7 all year long. They were the bear. In their November housing forecast, Fannie Mae puts the average 30-year fixed rate at 7.6% during the first quarter of 2024. The mortgage giant doesn't expect rates to drop below 7 until the second quarter of 2025. All told, Fannie Mae predicts rates will average 7.3 in 2024 and 6.9 in 2025. So obviously they were just the absolute bear here. While many current homeowners with low mortgages will likely continue to be discouraged from listing their homes, we would expect mortgage rates to trend down modestly in 2024, which should help kickstart a gradual recovery in home sales in 2025, says Doug Duncan, Fannie Mae's Senior Vice President and Chief Economist, on November 21st. Any thoughts about the bears?
No.
Yeah, they're just on the bear side.
Yeah.
Okay, let's go with Goldman. So Goldman Sachs predicts rates will remain above 7 in 2024, according to their November outlook. The new forecast for mortgage rates reflects a steeper yield curve, known as longer maturity yields are rising, which tends to increase mortgage rates. And Treasury yield volatility remains stubbornly high, according to Goldman Sachs' research. Okay, why? It's still the uncertainty in the economy. Everyone knows inflation is strong. We know it's sticky. And the Fed keeps telling us higher for longer. That's why Treasuries are going like this. If you go back and look at Treasuries in times of just like a regular market, they're like flat as a pancake. Versus in the last 60 days, that 10-year Treasury has moved almost 100 basis points in 60 days, aka 1%. That's not normal. That's a time of economic upheaval.
But also, it's because what they can get in treasuries is both good and bad depending on where it's at. And in the past, it was never looked at as a aggressive investment. But because with inflation and just the questions of equities and what companies should buy and the question of the economy, treasuries has almost a different value to people in general, but especially investors. I never thought in a million years I would hear my friends who have been heavy into the stock market and investing in things like real estate say, oh, you should get into treasuries.
Yes.
I mean, more people know about treasuries now. It's such a crazy time in history. And that's what makes real estate really interesting, even more, not necessarily risky, but more unpredictable, because there used to be more predictability because things didn't move as fast in the past.
When multifamily is trading at a 5 cap, and you can go get almost 5% risk-free on a treasury with the safest debt in the world, U.S.-backed debt, which is arguably the safest investment in the world, and you've got no breaking hot water tanks, toilets to plunge, and tenants to deal with, you look at that and you go, treasury looks kind of sexy.
Wow.
So, I mean, that's what's happening is you're having that flight because the yield got so high, that flight over to Treasuries. Realtor.com forecasts that rates will average 6.8%, dipping to 6.5. So although mortgage rates are expected to begin to ease, they are expected to exceed 6.5 for the whole calendar year. This means that the lock-in effect, and we just talked about it, the gap between what the mortgage market has and rates that are available in the market for existing homeowners, what we'll do is that'll keep being a major factor. And we agree with him. We're going to continue to talk about this. The Fed broke housing when they kept interest rates low for too long. And now that housing supply is locked up and those people are going to stay in their homes much longer, which long term is going to help places like Home Depot and Lowe's, local contractors. So there's always a play here. But I used to live in my home 6 to 7 years. Now I'm living in it 9. If rates stay higher for longer, we could see that average tenure in a home maybe go from to 10 to 15 years.
You think it probably was like that a long time ago? Probably 30, 40, 50 years ago?
No, so 30, 40 years ago, we only lived in a home like 6 years.
Oh, really? Okay.
Yeah.
When's the last time we lived in our homes this long, would you say, if you had to guess?
From the data, it appears that trend is going up right now.
But when was it like this in history, you think?
It hasn't been.
Really?
Wow. So, and I know that's hard for a lot of people because all of us have a friend or a family member or our parents, and they're like, they've lived in that same house.
But that's unique.
But that's unique when you take in the whole population and all housing inventory.
I'm actually a good example of this. I have 5 girls. Okay, there's 7 of us now. My father-in-law also lives with us. I don't know if this is against rules or not, but there's 8 of us in a 5-bedroom house. Okay, and we make it work. It's 3 bathrooms. But I have, to a certain degree, been trying to time the market for 5 or 7 years, and I do plan on building a home and having more square footage. But I'm constantly looking at rates. And so that's why I'm intrigued by this topic, talking about what's going to happen in 2024, because 7 years ago, I could have never predicted this. I remember putting an offer on 5-acre properties thinking, this is a horrible deal. Now those are screaming deals. Those would have been great deals. I should have gotten to those.
Yes.
And interest rates, back then weren't crazy low, but they were way lower than right now. And of course, if I knew that. And so that's the thing. I guess the takeaway for me in relation to interest rates is just like you don't want to time the market, you also don't want to wait for a certain type of interest rate. But it is a question I'm going to ask for 2024 on behalf of buyers at the end of the podcast. So stay tuned, you guys.
No, I love that. And everyone needs to hear what Benji just said. That's wisdom. People put off life events waiting for the perfect opportunity and the perfect pricing in their mind, either the price of the property or the interest rates. And what they do is we naturally delay trying to find the right one. And what time tells us later was we missed an opportunity because time will march on without us. And especially here in the Seattle Metro, most of the coasts, if you're listening on the coast, have rapidly appreciating markets that appreciate faster than inflation. And so Lance Otto and I were just joking about this because we just sold a beautiful 5-acre piece of land over here. He goes, hey, you remember that time we were talking about this piece of land over here on Lock Hill? And I was like, yeah. He's like, well, one of our other clients just bought this other one down the street from it for $385,000. Man, I remember when you could have bought that for $150. And he goes, I know, and both of us said it was expensive. So that's just what happens is real estate just continues to march on in these high demand, strong economic growth, beautiful areas, good climate, high wages. Okay, going back, NAR. Rates will fall below 7% in the spring. So what NAR is basically saying when they come out with this is they believe, hey, we're going to be high, but as that second quarter comes in, rates are going to be coming down. One thing to be thinking about with all of these forecasts, right? All of these forecasts on interest rates are saying second quarter. I want to play this out. When does the market light on fire from a seasonal perspective? When does it start?
Spring, usually.
The spring market. And the spring market is the beginning of second quarter. So this is going to be one of those double whammy years that if these predictions are right, The spring market will naturally be lifting up as rates are naturally coming down, adding to the exuberance of the market and most likely creating bidding wars in all of the tight inventory markets. So if you're a buyer or you're an investor, you probably want to try to get in contract before the beginning of the spring rush. And then hopefully 30 days later, as you're getting ready to close, rates are trending down. Okay. Hard to time this one, but you'll be able to see it happening. And that usually starts here in the Seattle Metro and most of the country, starts in March and April. And then the spring market usually peaks by like June. Okay. That's when most real estate markets peak. When's the lowest interest rates going to happen? Probably end of second quarter.
And the mistake people would make is they're like, oh, but if I wait a little bit longer, interest rates would go even farther down. However, what we know is with low inventory,
bingo,
and not as many houses being constructed right now, it could actually force prices to go up the lower those interest rates are. And ultimately, even though interest rates being low are nice because your mortgage payment is lower, I mean, think about how much more you're paying. Well, yeah. It's already crazy prices right now. So if it goes up from here,
yes,
on the surface, and this is one of the mistakes buyers make, they do it just based off of mortgage payments, which that's life, right?
Yep.
But then you think about how much you're paying long term and all this. So it's kind of a balance. And that's why I think what you just said probably is the most important part of this whole podcast in relation to interest rates, because you're going to have the convergence of low interest rates starting and prices of houses being the lowest it might be on average in the next decade.
Yes.
That's kind of crazy.
It's really crazy.
So that spring, summer is a window, right?
The same thing applies to land development projects. The same thing applies to multifamily. The land developers in the spring, as their inventory sells, will feel naturally okay because it's selling quickly. They will start to buy more, and as interest rates go down, demand will go up. The multifamily cap rates have been rising, and in the spring, as interest rates start to go down, boom, it's going to be a wild ride. That's the part I need everyone to understand. Like, it's going to be a little crazy and a little funky, and we're not going to be able to predict or time this correctly. Mortgage Bankers Association, once again, they were one of the bulls. They said rates will decline to 6% by the end of the year. Both fiscal and monetary policy have contributed to a much higher level of mortgage rates in 2023. The NBA chief economist, Mike Fratantoni, said in a statement, the Fed's hiking cycle is likely nearing the end, while the Fed officials have indicated that additional rate hikes might is a key word, not be needed. Rate cuts may not come as soon or proceed as rapidly as previously expected. So remember, the Fed's going to keep talking tough to us, but go back to that example. If real rates are 2%, and that was because inflation was 3.5. If inflation goes down to 2.5, the Fed has some cutting ability in there. Okay, last but not least, Wells Fargo, they were also one of the bulls. They were talking 6% by the end of the year. Realize at 6%, these busy metros light on fire. At 6%, the Seattle Metro, we're on fire again. That's bidding war time. It's going to be bidding wars this spring, regardless of rates anyway, just due to low inventory. Anyway, they said that in their latest economic outlook, the economics group of Wells Fargo puts the 30-year conventional mortgage at 7.2 in the first quarter of 2024, declining all the way to 6.05 by the end of the year, and they predict below 6 in 2025.
I really want to get to some of these fun topics like Bitcoin. So let's get to the next one, which is what is mortgage rate spread right now?
Yeah.
Explain what the spread is and why that's important for people to
so
about.
The mortgage rate spread, our listeners probably only care, and a home buyer only cares, and a real estate investor only cares. Cool. What is the 30-year fixed debt cost? The 30-year fixed debt cost is based on a mortgage point spread. So generally speaking, when you look at it over the last decade, you can see the median was 1.73%. So traditionally speaking, over the last 10 years, that's about 170 to 180 basis points is that spread, or 1.7 to 1.8%. 100 basis points is 1%. So normally 1.8, and today that number is sitting at 300. So there's a big gap between what's happened over the last decade and where the mortgages are going out today. So there's a 1.2% gap. Why is this happening? It's happening for a variety of reasons. One, lenders perceive that in tough economic times, it's more risky for them to originate a loan. So they're gouging the borrower a little bit, okay? Because the Fed's in a raising cycle, because the economy's, contracting, because unemployment's going up. Two, banks make money two ways on debt. They make money when they make it, aka originate it, and they make money when they collect your payments, aka servicing it. All the loans they just issued at 8%, how long are those going to stay on their books? Like, is someone going to hold that for 30 years?
No, probably not.
No, they're going to refinance that debt as fast as humanly possible. So the second that debt comes down to 5-6%, that 8% mortgage is getting refied. So if they know they're not going to get their servicing premium and make that extra money out of the servicing, what they're doing is they're gouging more up front. So instead of the 1.8 that's usually there, they have 3% right now. So what they do is they look at the 10-year Treasury. The 10-year Treasury today was 4.11%. So 30-year debt today is 4.11 plus those 300 basis points, or 7.11%. That's how this works. Well, if that margin compresses and goes away, you take 4.11 plus 1.8, which would be what it's been for the last decade. That puts rates today at 5.91. P.S. That's the Fed not dropping their rate at all. That's if mortgage bankers' margin naturally compresses. We're just under 6 today. We didn't have to do anything. So you've got both of these factors. You've got the Fed and their margin compressing is both going to bring this interest rates down.
So completely crystal ball question here. If that's the case, what if we went back down to the 1.6, 1.7% spread?
Yes.
And the Fed drops the rates. Could we potentially get back to a 4 or 5% interest rate? And
Bingo.
When do you think that could happen if all the stars align? Because the next question is, what would affect these in the opposite direction?
Yeah.
But what would that be, and when would that be if you had to just put your crystal ball hat on?
Late 2025. So this is how those economists, in my opinion, are projecting towards the 5s in 2025. So I don't think we'll get to the 4s. I want to make that part clear. But this would allow us to get into the mid 5s. Okay, maybe even the low 5s if we were lucky. So I'd say mid to late 2025, we could be in the mid 5s if inflation comes down, if we're not, geopolitical events, if the economy is still doing good and the Fed lowers the Fed fund rate. As uncertainty leaves and more banks start fighting, their margin compresses, and the Fed, as inflation leaves, compresses the real interest rate.
Mind blown.
This was fun. I mean, This was literally fun. Like sitting around figuring this one out and okay, let's, how do we look at this from multiple angles?
For sure. And I think this is a really important topic to cover, is what happens, or what would make it so that interest rates wouldn't go down. What are the things that we should look out for as 2024 not only comes upon us, but we're in it?
The biggest one that we have to be concerned of is inflation. So inflation is sticky. Inflation's not transitory. That was a bunch of BS. You can't print trillions of dollars and not expect everything to become more expensive. And inflation in the past in the United States has proven to be sticky. So it doesn't always leave quickly. So if the Fed thinks the fire is out and takes their foot off the gas too much because of political pressure, because of elections, because of the economy, that could cause inflation to come up, and then the Fed could have to raise again. That's a possibility. The idea of higher for longer. The Fed is still in a quantitative tightening cycle. So they're selling off their mortgage-backed securities right now. If the Fed slowed down their sell off of the mortgage-backed securities, or sold too many of them all at once. So if they just flooded the market, rates could pop up again. If other countries aren't buying as much as those mortgage-backed securities, rates could also pop up. Part of this just overall fear is part of the Fed's messaging, higher for longer, the Fed could just literally maintain rates in the 5s for the Fed fund rate, which is putting us in the 7s. They could just do that for the next 2 years. The Fed is an independent organization. They're not really governed by anyone. They're an independent. There's no oversight for the Fed. So if the Fed decided, hey, we're just going to keep these rates even as inflation goes down for the next 2 years, we could be higher for longer. Low unemployment. Unemployment needs to go up. I don't want this to happen. I don't want anyone to lose their job. I want everyone to always make more money. But when we're talking about interest rates, if unemployment stays low and job growth stayed hot and wage increases stayed hot, interest rates will not come down if that's the case. Next one. Strong dollar. If some major world event happens or something happens that causes flight to the dollar and strength in the dollar, that strength in the dollar pops up the yield on treasuries, which causes mortgage rates to stay higher. Also, oil. The world is a petroleum-based economy. If oil production got massively interrupted, if, a war stopped it or something of that nature, that can be inflationary quickly. And that could cause rates to stay higher for longer. And of course, major geopolitical events, these wars, these conflicts, things like that, that has the ability to keep rates higher for longer too.
So the things that would potentially keep interest rates from going down, maybe even going up, or inflation.
Yep.
If it stays sticky or potentially goes up.
Yep.
Secondly, low employment. Third, strong dollar because there's a flight to it, which, if correct me if I'm wrong, it's because the banks would have higher mortgage rates because they're making potentially money from the influx of outside money. Is that how it works? Why would they keep it up just because there's a flight to the dollar from outside the country?
The flight to the dollar from outside the country causes the yield on our treasuries to go up.
Okay, because there's a higher demand.
Because there's a higher demand.
Got it. And that affects the banks.
30-year. That affects 30-year
Got
debt.
it. Yeah.
Always have in mind that the 30-year mortgage is most closely tied to the 10-year treasury.
Yeah.
So anything that affects the 10-year treasury affects what consumers pay for 30-year debt. That's the moral of the story that you should know.
Okay, I actually have a fun one on that, and then let's move to Bitcoin. This is kind of a curveball for you. What would drive interest rates way down? What are the top 3 off your head? I actually have a few on my mind.
Okay, so what would drive interest rates way down is if we hit a deflationary cycle. All major developed economies need inflation to keep them moving, to keep them humming along. And what that is that stable prices growing at a stable rate.
2%.
2% is the target for the Fed. But if prices destabilized and started dropping, because, let's just doomsday this. You saw it during COVID. So COVID happened, money printing happens, economy and supply lines shut down, and then prices for everything just shoot through the roof. I mean, cars went up 30, 40%, lumber went up. Groceries went up. Now, a lot of that's come back down. But what if all of a sudden groceries started depreciating? Depreciating is when they go down in price beyond where they were. And lumber goes down because the inputs are the same. So the price you sell something at, if the material to produce it hasn't gone down and the labor to produce it hasn't gone down, but the price to produce it has gone down, everything starts breaking. That would break everything, which could cause the Fed to turn on the money printers.
Which leads into maybe the second part, which is an economic crash or a bank failure would also potentially drive it down.
Yes, absolutely. And it wouldn't be just a bank failure. It would have to be a bunch of bank failures. This would have to be Lehman Brothers style, more than Silicon Valley Bank, more than that. It would take something like that. Also, wars. Wars have the ability to very much drive down our interest rates because they have to crank up the American industrial complex to feed the beast. Okay, well that means
the beast is already big and hungry, and national debt is a whole nother discussion.
Bingo. Yeah.
But what's interesting is we're talking about rates here at the end of 2023, which are between 7-8%, depending on your credit score. We're predicting what could potentially happen, most most likely in 2024, which interest rates could go down to potentially 5 to 6%, right? Give or take some bulls and bears predictions. But gold and Bitcoin. Gold has kind of stayed steady Freddy for a very long time, but has had a bump up just barely. But Bitcoin is really ripping now.
It's been ripping.
And this is what's interesting about your theory of why it's ripping from a real estate investor standpoint.
So they've both been ripping, and gold surged to an all-time high. Boosted,
Really?
yeah, just hit and this is just a couple days ago. Gold just hit an all-time high because traders were ratcheting up their bets that the Federal Reserve will cut interest rates next year. That's also what's been happening to Bitcoin too, is people go, oh, the dollar is going to go down. I've got to move out of my dollar. Boom, I'm going to put it in gold. Boom, I'm going to put it over here in Bitcoin. So the dollar fell, and this also against other currencies, over the last few weeks. And then this also happened to Treasury yields as these investors have grown more confident that the Federal Reserve is going to lower rates. So we just talked about that. The 10-year Treasury, it came down almost a full point, which caused mortgages to come down almost a full point. Why? Because people are starting to believe, and when they say traders, they're talking big money hedge funds. They're starting to believe the Fed is going to lower next year. And so that means the dollar's going to devalue, which lowers the yield on treasuries, which makes gold and Bitcoin more attractive. So this same just applied to Bitcoin. It was a strategy that people were doing where traders started switching their investment strategies after nearly 2 years of following a different playbook. We were just talking about it. Your friends were like, hey, treasuries are cool. Treasuries are cool at 5%. As treasuries go back to their long-term, 1.9, that's no longer cool. And it doesn't feel as fun. So a bunch of money's been going into Bitcoin and gold. So why else has Bitcoin risen so much this year?
Because it went so far down,
Yep.
right? So it was a good entry point for people that want to get in. People are dollar cost averaging. A second reason it's going back up is because I think the stock market was going up, and some people think there's a correlation there.
Yes.
So those are my two guesses.
Both of those are 1,000% correct. When people feel like they have more money, they put more money into alternative assets, aka gold and Bitcoin. So that always happens. 3, the scandals are dying down. We're hearing less about the FTX collapses. We haven't seen another, major exchange have a problem. Then you add in the political unrest, okay? And you add in these wars in Ukraine, Russia, Hamas, Israel. That causes more of a flight to gold, a flight to Bitcoin. And then basically, the Federal Reserve overturned financial markets, okay, when they took interest rates from 0 to 5.25%, so over 500 basis points, the fastest they've ever done it in the last 30 years. So they flipped it over. So because they flipped it over, and now they're signaling, hey, we might be done, people look around and go, gold, Bitcoin, let's rock and roll. When Jerome said that we're well into restrictive territory and they're not going to raise, and then I'll bet money we're not going to get a raise again here in December, that the Fed is basically done hiking, boom, alternative assets, dollar's going to start devaluing. So in summary, believing that the Fed is done with rate hikes, that the dollar is devaluing, and that treasury yields are going down has had the opposite effect, and probably will continue to have the opposite effect on gold and Bitcoin, which caused them to just, boom, rip to their all-time highs. That's not investment advice. I don't own gold other than maybe some coins and bars, but don't actively trade that. I don't actively trade Bitcoin. I do hold it, but this is just what we're seeing because of interest rates.
a one curveball question as we land the plane here. So one reason Bitcoin and gold both are going up is part of technology. So more people are on social media, more people are reading articles, more people care about the economy and economics. And so you said as confidence, starts growing, which is directly correlated to what people are seeing and reading. And you just said because there's not as many scandals, people feel more comfortable, more confident. Could the same thing potentially happen to real estate? Now, you and I are kind of like saying, hey, you guys need to get into real estate right now before the horde gets in here.
Yeah.
But do you think come the springtime and the summer, as the narrative changes, right? Interest rates are going down right now. The number one story is homes aren't selling. House prices are way up. Interest rates are way up. Will the trajectory or the momentum be even faster in 2024, if you had to guess, in terms of people returning to the market, both selling and buying?
That is a brilliant question. In 2024, I believe that the consumer will react much, I'm talking 3 times faster than normal to interest rates, because what is being shown is that even though nationally we're at like 3.8 million transactions, we're not going below there. So we're at base level demand with low supply right now, and we know building permits are down, so there's less supply coming. So I think that buyer, the second that interest rates get near a number that they feel creates the affordable payment, they jump in instantly, because they've already been waiting on the sidelines and the demand is clearly sitting there. Flip it over to the seller side. I don't think the seller enters the market. I don't think that these slightly lower rates are enough to make them want to move. So let's just talk about you, okay? What's your interest rate?
Right now, currently, 3.6.
3.6,
yeah.
Okay.
Actually, no, 3.25.
So let's just say you're in the market right now today. Would a 6.5 entice you to trade in your that's the point, is that 92% of all mortgages are in that low rate. And so we're not going to be able to entice those sellers to the market until we get lower rates, which means investors and builders get to fill that gap. That's an opportunity as an investor and a builder. It's also an opportunity as a landlord, because there's going to be more people forced into rentals. It's also something people should realize about the next 2 years is they've got to get their credit better. They got to get better down payments in order to be able to compete, because as those rates go down, it's going to become harder to compete. It's going to become